Brad Williams, Frugal Finance, bonds, fixed income securities. You think you understand the lingo? You think you understand the lingo? I'm going to go over quickly about 100 different key terms used in the industry. Agency securities. An agency security is a debt security issued or guaranteed by an agency of the federal government or a government-sponsored enterprise. These securities include bonds and other debt instruments. Average maturity. Average maturity is the average time that a mutual fund bond holding will take to be fully payable. Interest rate fluctuations have a greater impact on the price per share of funds holding bonds with longer average lives. Basis point. A basis point is 1/100th of a percent. 1% equals 100 basis points. 1/2 of 1% equals 50 basis point. Bond traders and brokerage firms regularly use basis points to state concise differences in bond yields. The Federal Reserve likes to use basis points when referring to changes in the Fed funds rate. Benchmark. A benchmark is a standard against which investment performance is measured. For example, the S&P 500 index tracks 500 major U.S. companies, is the stated benchmark for large company U.S. stocks and large company mutual funds. Bondholder. The owner of a bond is known as a bondholder. This may be an individual or institution such as a corporation, bank, insurance company, or mutual fund. A bondholder is typically entitled to regular interest payments as due and return of principal when the bond matures. Bond rating. A bond rating is a method of evaluating the quality and safety of a bond. This rating is based on an examination of the issuer's financial strength and the likelihood that it will be able to meet scheduled repayments. Nationally recognized statistical rating organizations provide ratings on a scale, usually using letters or numbers, and might distinguish between investment grade and non-investment grade. Call. In relationship to bonds, a call is the issuer's right to redeem outstanding bonds at a set price before the stated maturity. Call protection. Call protection is a feature of some callable bonds that protect the investor from calls for some initial periods of time. Capital gains tax. Capital gains tax is the tax assessed on profits realized from the sale of a capital asset such as stocks, bonds, or real estate. Collateralized mortgage obligation, also known as a CMO. A CMO is a bond backed by multiple pools, also called tranches of mortgage securities or loans. Commission. A commission is a fee paid to a brokerage firm or investment professional as an agent of the customer for executing a trade based on the number of bonds traded or the dollar amount of the trade. Corporate bond. A corporate bond is a bond issued by a corporation to raise money for CapEx, operations, and acquisition. Convertible bond. A convertible bond is a bond with the option to convert into shares of common stock of the same issuer at a pre-established price. Coupon. A coupon, also called the coupon rate, is the interest payment made on a bond, usually paid twice a year. A $1,000 bond paying $65 per year has a $65 coupon, or a coupon rate of 6.5%. Coupon yield. Coupon yield is the annual interest rate established when the bond is issued. The same as the coupon rate, it's the amount of income you'll collect on a bond expressed as a percentage of your original investment. Current yield. Current yield is the yearly coupon payment divided by the bond's price stated as a percentage. A newly issued $1,000 bond paying $65 has a current yield of 6.5%. Current yield can fluctuate. If the price of the bond dropped to $9.50, the current yield would rise to 6.84%. Debenture. A debenture is an unsecured bond backed solely by the general credit of the borrower. Debt security. A debt security is any security that represents loan money that must be repaid to the lender. Discount. A bond discount is the amount by which a bond market price is lower than its issuing price. A $1,000 bond selling at $970 carries a $30 discount. Diversification. Diversification is an investment strategy for allocating your assets available for investing among different market sectors, industry, and securities. The goal is to protect the value of your overall portfolio by avoiding overemphasis on a single security or asset class. Face value. The amount the issuer must pay to the bondholder at maturity is its face value, also known as par value. Full faith and credit of the U.S. government. Treasuries, savings bonds, and debt securities issued by federal agencies are backed by the full faith and credit of the U.S. government, which is a promise by the U.S. government to pay all interest when due and redeem bonds at maturity. Fixed rate bond. A fixed rate bond is a bond with an interest rate that remains constant or fixed during the life of the bond. Floating rate bond. A floating rate bond is a bond with an interest rate that fluctuates, usually in tandem with a benchmark interest rate during the life of the bond. General obligation bond. A GO bond is a municipal bond that is secured by the government issuer's full faith and credit, usually based on taxing power. Government-sponsored enterprise. A GSE is an enterprise that's chartered by Congress to fulfill a public purpose, but it's privately owned and operated, such as Federal National Mortgage Association, Fannie Mae, and Federal Home Loan Mortgage Corporation, Freddie Mac. Unlike bonds guaranteed by a government agency such as Government National Mortgage Association, Fannie Mae, those issued by GSEs are not backed by the full faith and credit of the U.S. government. High-yield bond, a high-yield bond, also known as junk bonds or non-investment grade bonds, is a bond issued by an issuer that's considered by nationally recognized statistical rating organization to have a higher risk of default as indicated by a low bond rating, typically below investment grade. For example, a BA or lower by Moody's Investor Service or BB or below by Standard & Poor's Corporation. Because of this risk, a high-yield bond generally pays a higher return than bond with an issuer that carries lower default risk. Indenture. An indenture is a legal document between a bond issuer and trustee appointed on behalf of its bondholders that describes all of the features of the bond, the rights of bondholders, and the duties of the issuer and the trustee. Much of this information is also disclosed in the prospectus or offering statement. Investment grade bond. An investment grade bond is a bond whose issuer's prompt payment of interest and principal at maturity is considered relatively safe by a nationally recognized statistical rating organization as indicated by a high bond rating, BAA or better by Moody's Investor Services or BBB or better by Standard & Poor's Corporation. Liquidity. Liquidity is the ease with which an asset or security can be sold without affecting its market price. Liquid investments can be bought and sold with relatively ease and without a significant change in price. Liquidity declines whenever it becomes more difficult to trade an investment due to an imbalance in the number of buyers and sellers or because of price volatility. Markdown. If you sell a bond, your brokerage firm, when acting as a principal, may offer you a price that includes a markdown from the price that it believes it can sell the bond to another dealer or another buyer. The markdown is the firm's compensation in the transaction. Markup. When a brokerage firm sells you a bond in a principal capacity, it may increase or mark up the price you pay over the price the firm paid to acquire the bond. Markup is the firm's compensation in the transaction. Maturity date. Maturity date is the date when the principal amount of a bond, note, or other debt instrument is typically repaid to the investor along with the final interest payment. Mortgage-backed security. A mortgage-backed security is secured by home and other real estate loans. Municipal bond. A municipal bond is a bond issued by state, city, county, or town to fund public capital projects like roads and schools as well as operating budgets. These bonds are typically exempt from federal taxation and for investors who reside in the state where the bond is issued from state and local taxes too. Non-callable bond. A non-callable bond, also called a bullet, is a bond that includes a feature stipulating that the bond cannot be redeemed, called before its maturity date. Note. A note is a short to medium term loan that represents a promise to pay a specific amount of money. A note might be secured by future revenues such as taxes. Treasury notes are issued in maturities of 2, 3, 5, 7, and 10 years. Par value. Par value is an amount equal to the nominal or face value of a security. A bond selling at par, for instance, is worth the same dollar amount at which it was issued, or at which it will be redeemed at maturity, typically $1,000 per bond. Phantom income. Phantom income is income that's responsible to the IRS, but that hasn't yet been received, such as interest from a zero coupon bond, which isn't paid until the bond matures. Prepayment risk. Prepayment risk is the possibility that the issuer will call a bond and repay the principal investment to the bondholder prior to the bond's maturity date. Premium. In relationship to bonds, a premium is the amount by which a bond's market value exceeds its issuing price, par value. $1,000 bond selling at $1,063 carries a $63 premium. Primary market, the market in which new issues of stock or bonds are priced and sold, with proceeds going to the entity issuing the security. From there, the security begins trading publicly in the secondary market. Principal. For investments, principal is the original amount of money invested, separate from any associated interest, dividend, or capital gains. For example, the price you paid for a bond. With $1,000 face value, the time of purchase is your principal. Once purchased, the value of your bond holding can fluctuate, meaning you can see an increase or decrease to the principal. A brokerage firm that executes trades for its own accounts at net prices, prices that include either a markup or markdown, is acting as the principal. Prospectus. A prospectus is a formal written offer to sell securities that sets forth the plan for a proposed business enterprise or the facts concerning an existing business enterprise that an investor needs to make an informed decision. Real rate of return? The real rate of return is the rate of return minus the rate of inflation. For example, if you're earning 6% interest on a bond in a period when inflation is running at 2%, your real rate of return is 4%. Revenue bond? A revenue bond is a type of municipal security backed solely by fees or other revenues generated or collected by a facility, such as tolls from a bridge or road, or leasing fees. The creditworthiness of revenue bonds tends to rest on the bond's debt service coverage ratio, the relationship between revenues coming in and the cost of paying interest on the debt. Risk is the possibility that investment will lose or not gain value. Risk tolerance? Risk tolerance is the amount of investment risk you're willing and able to accept. Savings bond. A savings bond is a U.S. government bond issued in face denominations ranging from $25,000 to $10,000. Secondary market. Markets where securities are bought and sold subsequently to the original issuance are known as secondary markets. Security provisions outline the priority of claims, redemption, provisions, and collateral for the bonds in the event of default. This includes the order in which the bondholder will be paid, the pledge of assets and revenues to support the bond's repayment, and other covenants. Unsecured bonds or debentures are not backed by specific collateral. Separate trading of registered interest and principal securities. Strips are Treasury Department sanctioned bonds in which the principal and interest payments are stripped to become separate securities, each of which is then zero coupon securities that matures separately. Treasury inflation protected securities. TIPS are U.S. government securities designed to protect investors and the future value of their fixed income investments from the adverse effect of inflation. Using the Consumer Price Index as a guide, the value of the bond's principal is adjusted upwards to keep pace with inflation. Treasury are negotiable debt obligations that include notes, bonds, and bills issued by the U.S. government at various schedules and maturities. Treasuries are backed by the full faith and credit of the U.S. government. Treasury bill. A Treasury bill, also called the T-bill, is a non-interest-bearing, zero-coupon debt security issued by the U.S. government with a maturity of 4, 8, 13, 17, 26, or 52 weeks. Treasury bond. A Treasury bond is a long-term debt security issued by the U.S. government with a maturity of 20 to 30 years, paying a fixed interest rate semi-annually. Treasury note. A Treasury note is a medium-term debt issued by the U.S. government with a maturity of 2 to 10 years. Total return is all money earned on a bond or a bond fund from an annual interest in market gains or loss, if any, including the deduction of sell charges and or commissions. Yield is the return earned on a bond, expressed as an annual percentage rate. Yield curve. A yield curve is a graph showing the relationship between yield on the y or vertical axis and maturity on the x or horizontal axis among bonds of different maturities and of the same credit quality. Yield to call. Yield to call is the rate of return received by an investor who holds the bond to its call date and redeems the security at its call price. Yield to call assumes interest payments are reinvested at the yield to call date. Yield to maturity. Yield to maturity is the overall interest rate earned by an investor who buys a bond at the market price and holds it until maturity. Mathematically, it's the discount rate at which the sum of all future cash flows from coupons and principal repayment equals the price of the bond. Yield to worst is the lower yield of yield to call and yield to maturity. Investors of callable bonds should always do the comparison to determine a bond's most conservative potential return. Yield reflecting broker compensation. Yield reflecting broker compensation is the yield adjusted for the amount of the markup or commission when you sell and other fees or charges that you'll be charged by your brokerage firm for its services. Zero coupon bond. A zero coupon bond is a bond that doesn't pay a coupon. Zero coupon bonds are purchased by the investor at a discount to the bond's face value, e.g. less than $1,000, and redeemed for the face value when the bond matures. Comment if you have any questions as it relates to the lingo in the finance industry. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.